Compensation structures were also problematic. Some originators were compensated on the basis of particular loan features or loan volumes rather than on loan quality. Meanwhile, loans with features that may have been appropriate for a small subset of potential borrowers, such as interest-only mortgages or loans requiring little or no documentation of income, were offered to a much wider group of consumers. Studies have shown that if borrower income is held constant, loan features do matter to the repayment of a loan. So I hope we've learned that misaligned incentives that result in harm to consumers have implications for the economy overall. If we recognize this, then we must also recognize that consumer protections cannot be viewed as an ancillary component of a scheme to regulate for safety and soundness. Thanks, John. Rather, they are fundamental to the quality of the credit upon which our economy is built. Having said that, policymakers must also consider the desirability of a dynamic economy, one in which useful innovations are encouraged and credit is made available to as many consumers as have the ability to benefit from it. The tension between protecting consumers and making credit broadly available is one that is as important in making an individual loan as it is in ensuring the stability of the economy. The key to successful policy formulation is to resist the temptation to regulate the problem of the moment. For example, if in reaction to abuses in consumer and mortgage lending over the past years, we were to focus solely on consumer protection policies, the result could be overly restrictive access to credit, which would threaten future economic growth. On the other hand, if the policy focuses strictly on stabilizing the banking sector without giving due consideration to consumer protection, both consumer and investor confidence will remain weak, and we will risk repeating the mistakes of the past. Trust in the financial system can only be regained if sufficient consumer protections are in place to give borrowers reason to believe that they will be treated fairly. The Federal Reserve addresses its consumer protection responsibility in a variety of ways, using its regulatory and supervisory authority, as well as consumer education, research, and outreach capabilities. We take a multifaceted approach to consumer protection for a number of reasons. First, our organization is in the unique position of being a central bank as well as a regulator and a supervisor of the banking industry. Moreover, our experience in this arena has taught us that there is no one solution sufficient to address the information needs and substantive protection of consumers in credit transactions. By offering a broad spectrum of products, services, and activities, we aim to provide consumers with the information necessary to make good financial decisions. For example, based on our belief that clear and well-organized disclosures can help consumers make good choices among financial products, the Federal Reserve has used its regulatory authority to develop extensive new disclosures for a variety of financial products, including credit cards. We are currently in the midst of a major overhaul of mortgage disclosures. To ensure that new disclosures are useful to consumers, the Federal Reserve has used consumer testing to explore how consumers process information, how they understand important features of financial products. And this has been quite an informative exercise. We've used what we've learned from consumer testing to improve the disclosures we require. For example, when we recently revised credit card disclosures required to be provided to consumers at account opening, we learned that new rules require certain key terms to be included in a conspicuous table, because our field testing indicated that consumers were unlikely to read dense language, but they were comfortable with interpreting information in a table format. Our consumer testing efforts have also taught us that even the best disclosures cannot offer protection consumers need in all cases. Some aspects of increasingly complex products simply cannot be fully understood or evaluated by consumers, no matter how well educated the consumer or how clear the disclosure. In those cases, we've chosen to prohibit certain practices. For example, the Federal Reserve recently banned the practice of double-cycle billing when calculating interest rates on credit cards, because we found in testing that there was no reasonable way to explain the practice. We've also banned practices related to mortgage lending that have potentially unfair and deceptive features. We found that the failure to require escrow accounts for homeowners insurance and property taxes often cause borrowers to underestimate the cost of home ownership. So we made such escrows mandatory for high-cost loans. Similarly, we placed restrictions on the use of prepayment penalties. The Federal Reserve has also become more proactive in its efforts to make consumers aware of its role in consumer education and outreach. While we have a long history of providing unbiased, research-based information to consumers on a variety of financial products, we've stepped up our efforts to get information to consumers quickly. And we've recently made use of some unconventional venues, unconventional at least for a central bank. For example, to make consumers aware of the foreclosure rescue scams, the board recently ran a 30-second public service announcement, PSA, in movie theaters in 18 markets across 10 states having high foreclosure rates. Additionally, and importantly, the coverage that the PSA campaign received itself on television, radio, and in newspapers carried the message about the existence of mortgage rescue scams to a far broader audience. As a complement to the PSA campaign, the board developed a 5 tips flyer regarding foreclosure rescue scams. It provides essential information in an easily digestible format. Material developed by the board is now being leveraged by others. Several reserve banks, for instance, are working to add the board's PSA to additional theaters in their markets. And one reserve bank has decided to replicate the effort with a PSA tailored to its particular market. In addition, the PSA and the 5 tips have been picked up by other public and nonprofit organizations, including the National Association of Realtors and mortgage servicers, such as GMAC. The success of this campaign has highlighted the demand for timely information that consumers can use. And through this effort, we've learned a great deal about the importance of the Federal Reserve as an unbiased source of consumer information. We intend to build on this knowledge going forward, focusing on the content provided, leveraging the same message through multiple distribution channels, and creating an awareness of the information's availability. Finally, as a research institution, we engage in efforts to measure the effectiveness of financial education in order to understand what approaches work best. For example, board staff working with the Department of Defense and others conducted a longitudinal study involving soldiers at Fort Bliss to determine whether receiving a 2-day financial education course as part of their advanced individualized training improved the soldiers' financial behaviors compared to those who did not receive training. We found that soldiers who took the course were more likely to engage in positive financial behaviors, such as saving regularly, participating in retirement programs, and paying off credit card bills monthly, and less likely to engage in negative behaviors, such as paying overdraft fees and paying bills late. The Federal Reserve Bank of Philadelphia is currently engaged in a longitudinal study to measure the effectiveness of home ownership counseling. Through the Federal Reserve System, we continue to study and apply the lessons learned in the field of behavioral economics to improve our financial education and consumer information. The goal of each of the Federal Reserve's actions with respect to consumer protection has been to restore consumer confidence by making credit more transparent and, where necessary, prohibiting practices that are so complex as to be unfair and deceptive. These actions are not only good for consumers, but will benefit the financial industry. We aim to promote access to responsible credit for consumers to the greatest extent possible, while also recognizing the value of innovation and the need to restore fully functioning credit markets. Being attentive to the interconnection between meaningful consumer protections and broad access to credit will ensure a more lasting and sustainable economic recovery. And with that, I'd like to come full circle and end with the importance of dialogue between the Federal Reserve banks and the regions they serve. This conference is an excellent example of the ways in which policy is shaped by your involvement. Every day across all 12 Federal Reserve districts, we leverage forums such as this, as well as partnerships with financial institutions and community groups, to better understand how financial products are shaping the communities that make up our vast economy. So I'd like to commend you for taking the time to engage in thoughtful consideration of policies that will help alleviate the impact of the current housing and economic crisis on your neighborhoods. I also look forward to a continued discussion of that role and the role that strong consumer protection must play in our economic future. Thank you for letting me spend some time with you, and most importantly, thank you all for being here today and for all that you do in your communities.